So I've been fielding a lot of calls lately from clients, prospective clients, people in my trusted advisor network, and they're asking me, what are you seeing in the marketplace? From multiples, from valuations, activity, the type of buyers, the list goes on and on and on. So, now that we just recently passed through, the first 6 months of the year, I thought today would be a great time on this episode to talk about, what has transpired from our perspective on the first half of the year and also what we expect in the second half of the year. I want to welcome you back to our podcast, The Ins and Outs of Selling a Business. My name is kdee, President of Osage Advisors. So the markets have been, let's say, interesting in 2024, first half of the year. I think from a perspective, from enthusiasm, a lot of people were thinking that, coming out of 23, which was a down year, that 24, there's a lot of optimism in 24. And quite frankly, that really hasn't been the case. What we're seeing, what's happened is, deal volume consistently is underperforming. Again, you got to quantify this with, 22, 21 were great years. 23 was a down year. 24 has started off slow. The deal volumes have been much less than anticipated, even though there is a ton of money on the sidelines. So it kind of doesn't equate, right? You got, in private equity, I think like $1 trillion at the beginning of the year ready to deploy to go to work, but deals are not materializing. And I think there's several factors that play into that. I mean, clearly, interest rates have played a big part. They've affected valuations. The deals in that, and you kind of break the market into a couple sectors, right? There's the deals from, 100 million to 500 million, and there's the transactions that are, less than 100 million in revenues, size deals. So when you look at it, those larger deals have really slowed. And the multiples on those deals, what people are willing to pay as a multiple of earnings, has consistently been reduced. So a deal that traded, at maybe an 8 multiple, 2 years ago, is trading at a full turn and a half less. And you get to the bigger deals, even the $250 million to $500 million deals. And this is not me speaking. This is some, I'm looking at data that I have from several subscription services that we belong to. They have turned down even more, 2 times. That's a significant reduction, right? The bright spot in all this is those smaller deals. Those companies that typically trade, in that $10 to $25 million of valuation. They are still holding up the market. And believe it or not, those multiples have stayed steady over the last couple of years, and in some cases have increased. So if a deal a year ago was trading at a 6 multiple, it's still trading at a 6, maybe a 6.3, depending on the industry, depending on the competition, depending on the trends. There's a lot of activity. So at the end of the day, what's happening here, and a lot of this is coming from private equity data that we look at, analytics, statistics, whatnot, is that add-on market, that those deals where private equity is buying companies to bolt onto their portfolios remains extremely active, and frankly has been driving the market. We're seeing it from our perspective because the majority of our deals are in that $10 to $25 million range. And we have several deals in market right now, which I'll get into in a little bit, about what we're seeing from, quote unquote, boots on the ground on these deals. So you have an environment right now where there's a ton of cash out there looking for deals. You also have an environment where the fundraising activity of these PE funds raising new funds is very robust. So I think the first quarter, the number I read was something they raised 155 billion of new capital to deploy to make acquisitions. So it's kind of like, how's that happening? You got slower deal volume, you got a ton of money on the sidelines, and they continue to raise more money for new deals, for new funds. So what that's telling you is that the investors in these funds are looking for higher returns long term, and they're willing to be somewhat patient when the markets do turn, I guess. But today, right now, you look back at the first half of the year, things have been slow at the larger end, those larger type deals. And I can attest to that in the fact that we went to a conference, about a month ago, maybe 5 weeks ago, where we met with, 30, 40 private equity firms at this conference. And we kind of got the same sense. They're actively looking to deploy money, but they want those bigger deals. And those bigger deals really aren't out there. Those, what I would say, 5 to 10 to 15, 20 million EBITDA deals are hard to come by. They're not in market. And I think you could attest that to the fact, or look at that, is that owners understand that it's kind of a choppy waters right now. And they know valuations 2 years ago were, maybe a 10 to 12 multiple, or now are 8 to 10 multiple. And they're saying, you know what? I'm in a good position. I got a good team. I'm just going to kind of wait this out and see what happens. The financing, I guess I would say that the credit markets are, consistently driving the suppression of multiples at the larger end. Also, getting those facilities in place for private equity funds are somewhat difficult, challenging. You're obviously, cost of capital is way up, so that's going to affect the multiple you're willing to pay. The percentage of cash flow of the business to support the debt service. And then you get to the smaller deals we talked about. They are robust. They are really active. A lot of the reason why is that these equity funds or strategic buyers, they already have their credit facilities, loans in place, acquisition lines in place to make these acquisitions. And it's not like they need to go out and borrow $50 million, $100 million, $150 million. They need to maybe borrow, $4 million or $5 million. Or put some kind of structure in these deals so the ownership gets, the majority of what they're looking for at closing, and then, maybe through a seller note, some kind of earn out, be creative in the structure of these deals to get them done. So I think those trends are likely going to continue into the second half. We may see, they're talking maybe a one interest rate cut after the summer. We're also now in a highly political season, right? We're 100, maybe 120 days away from the election. A lot of people are saying, let's wait and see what happens. Uncertainty is never a good thing. Any kind of uncertainty in the marketplace, whether political, whether economical, whether it's personal, whatever, it tends to raise the skepticism bar and, of course, reduces value. So I think interest rate environment, the current state, let's see what happens politically. People are still on edge on the economy. Although all the numbers come out, GDP's up, job growth is good. I think I read this morning as I'm coming in this morning, inflation is, down to 3%, whatever that means, right? What's in that basket of inflation. It sounds good, but, the word on the street is that, that the sense is hesitation, for lack of a better word. I do believe that people are they don't believe what they're reading. They see it in their factories. They see it in their people. They see it in their challenges. And so they're kind of being a little bit hesitant about putting that capital to work, which at some point that dam has got to break open, not only from the standpoint of the acquisition side, deploying the money, but if you look at the other side, these equity funds have, and I've read about this, and you can read about it as well if you Google it or whatever tools you use, is that they are having troubles looking to exit some of their portfolio companies. Things that they've held, say from 2018 or 19, it's now 4 or 5 years later, they're sitting on these investments and the markets are slow and they're not seeing the returns that they want to get or they've kind of indicated to their investors they're looking for. So they're sitting on these portfolio companies, maybe re-engineering their debt side of it, maybe expanding the length they're going to hold it, maybe decide to make a few more acquisitions to kind of continue to grow and beef up that company. And so they're holding on to these investments longer than anticipated, which also was kind of affecting the market. So at some point in time, the dam's going to kind of break because you're going to have to do something, right? You have a life of a fund. You have to close the fund out, and then you're going to have to make that sell. And I think there's going to be a flood of deals coming to market. A lot of people thought it was going to be 24. Now it's looking more like after election in 25. So what's been a kind of seller's market at the lower end continues to be. That dynamic may start to change as you get into 25 because these equity funds have a number of portfolio companies, thousands of them. And how many they bring to market, I don't have the answer. But when you go to market, decide to go market in 25 and or 26, you are going to be part of a great larger group of companies that need to sell. So that seller-buyer mix may more equalize, which means the competition or the buyers may have more leverage, options, what they want to invest in and where they want to price their deals versus when you have an upper hand as a seller and there's only a limited supply, right? Supply and demand. There's only a limited supply of potential good companies in the market. You're going to get a lot of activity. So it's kind of a quandary right now. If you are a larger company looking to sell, the multiples are down, so you're hesitant to go to market. I'm going to wait. If you have those options, most companies do because they have large, let's say, detailed infrastructure management teams in place. It's not a one or two owners running it and need to retire. They got a really sophisticated corporate team in place. And then you get the lower end of the market, which remains very active. And that's an area where we still can see that being highly active going through 24 into 25. And, and we're seeing that in the deals we're working on. We have several deals, under LOI. And they're all in that, $10 to $25 million range. And we took a number of those deals to market either in the fourth quarter of 23, first quarter of 24. And the response or interest in our deals is up. I mean, typically we would put, 40 to 80 books out per deal. Now we're seeing 50 to 100 books. In one deal, we put out almost 200 books out. It was in the aerospace sector. People love that sector. We've never had that kind of volume of interest in a deal. Now, a lot of the buyers want to kick the tires and look at it and decide that it's not for them. But the level of interest in the deals that we bring to market is very enthusiastic, which is great for our clients because it gives them more options to choose the best buyer that works for them and at a multiple. As I said, the multiples at these smaller size deals, and they're not small to me, by the way. It's just the market says they're smaller, right? $10 million deal is a big deal. $5 million deal is a big deal, right? $25 million, $30 million deals. They're big deals for the families who are selling their companies. The fact that the multiples are staying consistent within that range over the last couple of years is encouraging to our clients. That we now puts us in a position where we can help negotiate through our competitive process to maximize the value for them, right? On the term, whether it's a 6 multiple, a 5.5 multiple, 6.5 multiple, whether we structure a little additional value into it through an earnout or seller note. We have a number of levers we can pull to work with our clients, knowing that a lot of people want to buy their business. This is the market where it's at right now. These add-on acquisitions are for portfolio companies, not just for PE firms, but for strategics, right? The strategic buyers who've been kind of quiet are now re-entering the market. We're seeing it because the number of strategic buyers interested in our deal flow in the first 6 months of, say, the fourth quarter, first 6 months of 24 versus maybe a year ago has increased substantially. And we go out to a very, a large breadth of strategic buyers in every deal. So we're seeing at the lower end of the market for the first 6 months, consistency, a lot of enthusiasm, demand for our client's business. So we're in a good position. I think that, my personal opinion, will continue through 24. As we get into 25 and beyond, my sense tells me there's going to be a flood of companies coming to market as the private equity firms need to divest of their portfolio companies. So that could cause some challenges, again, as the buyer-seller mix more equates to, there's 50 sellers and 500 buyers. Now there's going to be, 500 sellers against 500 buyers, right? I mean, just do the math. Buyers have more choices and they can look at more deals. Typical buyer, strategic buyer, they're development people, private equity, they're business development. They'll look at 500, deals a year, 30 deals a month, whatever, right? So if they have more options, they can work to their advantage. So need to be a little bit concerned going to 25 where multiples will stay. Obviously, depending on interest rates. I mean, clearly, if they drop down to where they were back in 21, was at 3%, you're going to see valuations go back through the roof. I don't anticipate that, but certainly if it equates back to more normalized rate structure historically, it's going to be positive for both sides. As the deals we're working on now, it's kind of a mixed bag. We have 5 deals currently, knock on wood, under a letter of intent, which we're really excited about. People are asking, so what's the structures like? We had a question, meet with a potential new client yesterday. I said, what are you seeing from a structure perspective? And again, so we have a deal, one of them, it's 100% cash at closing, which is great. We have another deal that's about 85% cash at closing and a short-term seller note for $2 million to kind of bridge that valuation gap. And you know what? And it's interesting because the reason why there's a seller note component of that is because of the financing requirement of the buyer. We capped as part of our deal, said, look, you can borrow money. I'm willing to take back a small seller note for a short time, but if you can't borrow more than X amount of the transaction. If you borrow more than X amount of the transaction, the deal's off, right? So they know that in this case, I think it's 45-50% of the overall transaction is part of is financed and the rest is equity. We have another deal that's, I guess they call it a little bit, it's like 80% cash, 85%, 90% cash at closing. And there's a small $1.5 million earnout, but it's not an earnout based on performance. It's an earnout based on the owners, 2 owners staying with the company for 2 years. So I guess I would call that a stay bonus, right? You need to stay 2 years to get the other $1.5 million. Doesn't have anything to do with the performance of the company. They just want them for 2 years, right? So, and then we're working on another deal that's, again, it's all cash at closing. All these deals, so it's a mix of 2 strategic buyers and then 2 portfolio companies of private equity funds. One's a family office, one's a PE fund, and they have a platform investment, and our client is going to be a bolt-on. And our multiples are consistent with what we talked about earlier, right? In that 5.5 to 6.5 range. So what we're seeing from the kind of deals we work on, in that lower range, we'll call it that, 10 to 25 million, it's consistent to what we've seen in the raw data or the data that's been summarized by a couple of different agencies. So the final deal that we're working on that's under LOI is, again, it's an all cash deal. The multiple is lower because it's in a sector that's been kind of beaten up a bit in the first half of the year. It's in the healthcare sector. And if you read anything in the healthcare sector, there's been a lot of It's been a mixed bag. And so that's reflected in the deal. But our client is going to stay on after he sells. He's going to work for them for a minimum of, he wants to work, continue. He just wants to do the clinical piece. It's a, urgent care, primary care business. He doesn't want to be burdened with administrative. He just wants to be a doctor, right? So this is a good deal for both parties. So we're seeing, and then we have two deals that are, we just got letters of intent in for two other deals, and they're consistent to what we just talked about. High percentage cash or all cash, and then either a small back end piece in an earnout or a note. And where the note's coming in is where these, the type of buyer, right? With equity fund, independent sponsor, strategic, they want to keep a carrot in there to make sure the owner stays on, and it could be a requirement of their bank. So our deal flow is consistent with the multiples we're seeing, and is consistent with the structures that have been kind of laid out in a lot of reporting. But the activity levels on all the deals that we just talked about, Osage, has been terrific, phenomenal, right? Our auction process has worked to the benefit of our clients to allow them to make an informed decision and choose the best buyers. They've had multiple opportunities, multiple conversations, multiple management meetings, and allow them to choose the best buyers. As I said earlier, moving forward, we anticipate these same activity levels at the lower end. We do have a few clients that are in the back, so like in the backlog or pipeline that have that higher EBITDA, that 7, 8 million, 10, 12 million EBITDA number. We're kind of playing that wait and see game. And we don't want to take them to market right now, knowing that, something that traded at a 10 to 12 multiple 2.5 years ago is going to trade at an 8 to 9 multiple now. They're patient, we're patient. And when we see a change in the market dynamics, then we'll have a conversation with the family and decide this is a good time to go to market. So overall, at the lower end of the market, things have been robust. Multiples, valuations have been consistent over the last couple of years, obviously depending on the dynamics of your business. But the trends we see moving forward will continue on those lines. The bigger deals, I think it's still going to be a slog going into the second half of 24. And I think certain things have to break to start, obviously the tight credit markets need to be loosened up. The rates need to come down. And when we see those dynamics, you're going to see much more of those larger deals coming back to market and getting done. So it's been an interesting first 6 months of the year for Osage. And we have a lot on our plate for the second half of 24. We're very excited about it. We're expressing that when the meetings we're having with potential clients. And we're looking forward to a strong 24 for the lower market and continuing into 25. And I want to thank everybody for listening in on our mid-year market M&A recap. Again, my name's kdee, President of Osage Advisors. If you like our podcast, please feel free to subscribe to our YouTube channel, The Ins and Outs of Selling a Business. If you have any questions, feel free to email me at kdee@osageadvisors.com, or you can pick up the phone and call me at 860-767-3273, extension 1001. To learn more about our firm and how we help clients sell their businesses, you can visit our website at osageadvisors.com. Thanks again, and have a great day.